All right, welcome back, everybody. Today is St. Patrick's Day. It is March 17th, and we've had a couple doozy of a days here in the market, and just wanted to kind of make a follow-up video. I had some questions that came at me after the last video I made, and just wanted to, again, follow up with that. So we've seen some pretty drastic drops recently, and I'm making this video. You can see here it's 6:30 in the morning. This is Eastern Standard Time. So we got a couple hours before the market opens again for the day, but I wanted to talk through this real quick. Just to recap, if you didn't watch the last video, we are looking at the Dow Jones to kind of gauge the market. We have some indicators here. We have a standard moving average of 55. We have a standard moving average of 89. We also have a basic trend line drawn from this support here of 2016. That's January 24th, 2016, up to a support point here of December 23rd, 2018. And then we have some Fibonacci levels that span the top up here almost at 30,000, the high there of February 2nd, 2020, but they go down to March 1st, 2009. So that was the low of the 2008-2009 crash. So we're covering from 2009 all the way up to 2020, which is a huge amount of information that we're capturing in this Fibonacci sequence, as well as some trend lines. Now, my previous estimation is, you can see this purple level here of 17,200. We will talk about that in a minute. But the market dropped and sold off and has come down here into this 25,000 level. I'm going to mark that with a horizontal line. We will make it green because it's St. Patrick's Day. How about that? 25,000, right about there. Okay. So you can see that the market came down, hit that point, hit the trend line, and it bounced just a smidge, but the next day it opened and closed below. That whole candle is below the trend line. That brings some significance to that trend line. I don't think that it is completely just a downtrend yet. I do want to wait till those two red and blue moving averages cross to the downside before we actually call it a downtrend. You can see historically back here below my cursor where the red and blue moving averages have crossed, and that did in fact signify an uptrend, and we've been moving up ever since then. So we see some run up, right, before we get the moving averages to cross. That's pretty standard. So I think that this this downward movement will help signify a downtrend, but I'm still waiting to see those things come into fruition. I think that currently the market has hit this 382 level. Again, if I mark this with another line here, let's see, 382, it's pretty close. You can see that the back here, the market moved just above. You can see it moved just above that level, and that's really what this market hit. But the Fibonacci's bring that significance as well. That's the 20,800 level. And the market hit that and has retraced. We call it a dead cat bounce. The market, I anticipate to jump back up from its 2,300 level, up a couple thousand points today. I think it's going to retrace back up near this 25,000 point. The 25,000 point has a lot of significance there. And if it does tap that trend line from the bottom, that brings even more significance and weight to the trend line, therefore helping to signify a downward trend. If we draw a circle, the next level that I'm really looking at, as we talked about before, is over here. And that's going to be all of this congestion. And it's simply around this 5.0 level. So that's 18,000. And you can see where that point became a lot of resistance multiple times and some support. And that just has a lot of weight. And conveniently, the 5.0 level matches up with it. So I think that right now what we're seeing is going to see some upward push up to the 25,000 level. But in the longer term, later on in this year, the next 1, 2, and 3 months, I think we're going to see levels down in the 18,000 point. So when we think about the downstream impacts here, the ramifications, there's no travel right now. There is less purchasing. With people working from home, there's less gas being purchased. There's less car maintenance happening. If we don't travel, we're not buying the plane or train ticket. We're not renting a car. We're not staying in a hotel. We're not eating food at the restaurants. All those downstream impacts are going to cause layoffs. We're going to have home sales that go under. We're going to have people go into foreclosures. There's going to be a lot of downstream impacts that are just from these last 2 weeks already that will not be seen until later on in this year. And so that's why I think that we're going to see those lower levels. It's going to hurt. It's not going to be fun, but I do think that that is going to be a reality. I've got the RSI down here just as another indicator that I do follow. I run the standard 80 and 20 levels, and you can see that the market right now is showing 28. And 20 is usually the reversal point or the oversold point. And so I'm just waiting to see that thing come back up towards the 80 level, which will probably mean that we have retraced back up in price value towards 25,000 before we see it drop back down. So that's a quick recap of what we're seeing in the market as of today. Who knows what's going to happen when the market opens and what crazy things are going to go on. But for right now, hope that helps make some sense. Hey, let me know what you're thinking. What are you watching? What are you seeing? Let me know in the comments section. I'd be happy to chat with you there. But thanks so much. Be safe out there. That's it for now. Peace.